Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Joining us today is Shane Thomas with Catalyst Equity Partners. Shane is a co-founder of Catalyst. Shane, thanks for joining the episode today.
Hey, Trent. Thanks for having me. I'm happy to be here. Look forward to chatting.
Yeah, and today the deal we're going to talk about is a hairy one located in Houston. There was some natural occurrences during this deal, but before we get into that, I want to hear more about Shane Thomas. What did you start your career doing, and how did that get you to being a co-founder at Catalyst?
Sure. Yeah, I'll try to give the short story, but I'm from Toronto, Canada originally. So went to, undergrad, master's there. I'm a CPA by trade and education. So worked at a Big Four consulting firm for about 10 years. So many folks may have heard of PricewaterhouseCoopers or PwC. Spent, some time in the audit practice, and then I really transitioned into consulting at PwC. And then I moved from Toronto to Chicago, so I kind of made an international transfer. So that's what got me to the US in 2010. In 2009, I started buying single family. So, I graduated from college a couple of years prior. Real estate had always kind of piqued my interest. And at that time in 2009, I just said, hey, I wanted to get started. Didn't know, anything, to be quite honest, right? And just got started, so I started buying some condos and townhomes, really, smaller stuff. And, just my real plan was, buy, renovate, rent, and hold. That was the general plan. And then so I did that. And then I moved, I just grew a small portfolio. And then I moved to the US. And, as most people know, 2010 was the depths of the recession, right? And I was getting a job when a lot of people weren't. So, I remember the guy who hired me basically said, hey, I'm going to hire you, but we'll see how long you last, And so anyway, so I kind of put my head down and worked and kind of went up the ladder, if you will. And then in 2015, 5 years later, I had gotten married, and life on the road. I was on the road Monday through Thursday, 5 years in a row, every week. And life on the road, it was fun when I was younger. But I kind of had, we had aspirations to build a family and whatnot. And kind of had to make a decision at that point. Did I want to stay in consulting and continue to go up, and or did I want to make a pivot? And so, at that point in time, real estate in Canada had done well. So, I said, hey, you know what? I want to get into, real estate in the US. And, basically, I knew that being a finance guy and whatnot had, obviously followed the residential real estate market, but then really multifamily is what really piqued my interest, given that, and especially, units 5 and above, five units and higher, given that it was based on commercial real estate principles and really focused on NOI, versus kind of comparable sales. So, I basically spent, 2015, about upwards to like 9 months trying to buy my own deal. I had my own capital. I was going to buy a 15 to 20 unit in Chicago. And, looking back, it was kind of a blessing in disguise that, I learned a lot from that experience, but, I learned, that I could have gotten, I came across the fact that I could go bigger, and buy in, more business friendly, landlord friendly states versus Chicago being the total opposite of that. And so, so that's kind of where I kind of got introduced to passive investing. And I started off as a passive investor in a couple deals, LP deals in Texas in end of 2015. So that's kind of how I got my start. And then from there, kind of transitioned to the GP side starting in 2016. So I'll pause there and see if you got any questions.
Well, one thing I want to point out is you're not alone when it comes to starting with the single family. Real estate is intriguing, it's interesting. You want to be a real estate investor, and then doing that natural progression to build a bigger portfolio into multifamily. I love
Yep.
that. You're not the first person to talk about that. That's what I did, and that's what a lot of people have done. And it's just a great way to learn the business on a smaller scale. You're not risking everything that you have,
Yep.
on one deal. The other
Yep.
thing that I liked what you said was that you started as an LP. I think there's a lot of people that, they might not have the capital, but to buy their own deal outright, but they have enough capital to invest in a deal, learn that side of the business, learn how, when you get to the GP side, you
Right.
want to treat your LPs and how you want to communicate and all that fun stuff. So that is awesome. Talk to me about how you started Catalyst. So I know you were an LP investor. You wanted to get, and you're now on the GP side. What was that transition like going from LP to GP? And how did you, I guess, make that step into the GP side?
Yeah, no, good question. And just like you alluded to, I mean, when I stumbled across syndication, like most people, I'm sure I was a little skeptical, right? And I got a referral to somebody, and I just decided, did as much due diligence as I could at that time, and then started investing, and like you said, I learned a lot about what to do and what not to do, and then invested in a couple other deals subsequently. And then, this business is all about, building a team and whatnot. And you start surrounding yourself with folks that are, looking for the same things. And long story short, I met my now business partner in, I think early 2016. We met at a networking event. I was living in Chicago at the time. He was in Dallas. And, we just, kept in touch. We kind of came from, different paths and whatnot. But he was kind of going down that road, starting to invest passively and well. And we really just kind of kept in touch, and we were kind of like peers or buddies, if you will, like kind of like a gym buddy,
Mhm.
we were learning together and whatnot. And then I moved to Houston in late 2016 or mid 2016. And, that was kind of partly for business reasons, partly for personal reasons. And then once I hit the ground running in Houston, after this is probably a year or so, kind of after I started getting more experience with multifamily, and through my passive investing experience, I said, you know what, I think I have the skill set and, to, be on the GP side, have kind of seen a lot of things that we can do better. And then, I met my now business partner. And so we just basically said, Catalyst was not even an idea back then. It was like, hey, we know we wanted to invest in Texas. He was in Dallas. I was now in Houston. And, we just said, hey, let's just go try to find one deal together, right? Like with no intention to grow a company or whatnot. And so, we started touring deals together, making offers. And I mean, look, at the end of the day, it can be very lonely when you're by yourself, right? So like, we kind of learned with each other. And then we had our extended network of folks that also helped. And yeah, I mean, long story short, we looked at like, I think the stat was like 112 deals or something like that to find our first one. It almost took us, I want to say 9-10 months to identify it. And then we eventually got our first deal under LOI. It was a 125 unit deal, late 70s construction, just south of Houston. So workforce housing. Had a little bit of hair on it, which we'll get into. But yeah, that was our first foray onto the GP side.
And you guys, when you started this conversation on let's go find a deal, you intended on raising capital from outside sources. It wasn't just hey, let's go buy a 20 unit together. It's we're gonna go look for a syndication deal.
Yeah, exactly. Yeah, great point. I mean, we basically came up with some criteria and said, hey, we should buy X, Y, and Z deal. At the time, it was, hey, around 80 to 120 units. I mean, at that time, we were really looking at price point. It was more like, 4 to 7 million, because we believed we could raise $1.5 to $3 million between our network. And we eventually brought on an experienced partner on our first deal for a lot of reasons, right? A, to give us credibility. B, to help us with our, loan, and C, to help us with our investors, to make sure that we had somebody that had done this before, But yeah, the intent was always to go and raise money. And I think the one thing is, especially for, a lot of your, listeners who may be new, is that we started our quote unquote networking and building our database, many, I would say years prior to actually going out and soliciting, investors to our deal, right? So we were, networking, building our database and surrounding ourselves with like-minded people, for me, since early 2015, and so when we went out to investors on that first deal, they had already knew us. They knew what our goals were. They knew what our backgrounds were and whatnot. So I think that helps, right? Because a lot of people say that if you get a great deal, the money will come. I'm not so sure about that, and I wouldn't, go out and risk a lot of earnest money and whatnot, with that attitude, it's at least at that time. So, but yeah, so that's why we just broke it up and said, okay, hey, we got to raise 1.5 million. I could do 750, you do 750. And then we just broke it into small chunks, and then at that time, it made sense. So.
Well, and not only does it give your contacts and your network confidence in you guys that you can, you know what you're doing, they know your skill set, but also gives you confidence to go pursue a deal. If you guys are confident that you can actually raise the money that you need to go buy that deal.
Yep. For sure.
So before we get into the deal further, I have a quick question. All good teams, you've mentioned teams, you're talking about a team. Everyone has their own skill set. What is your skill set, or what are you in charge of when it comes to Catalyst Equity Partners and your guys' assets?
Yeah, that's a great question. And, that's one of the reasons why me and my partner have also had gravitated towards each other, right? Because we had the same vision and goals and ethics and business principles, I want to say. But, he comes from more of a, he ran his own business for 20 years, had a lot of kind of operational experience, right? Vendor management, et cetera. And then I come from more of a finance, accounting, consulting, so kind of the underwriting analysis, putting the story together, investor relations, and, and all that. So that's kind of the generally how we kind of split our roles. And then in the beginning, we kind of, everyone's wearing all hats, right? And we're kind of rolling up our sleeves. And as we've grown, we've kind of found our areas of where, like, hey, Shane's going to lead, like underwriting and investor presentations and the monthly financial analysis, post acquisition, right? And Prashant's going to lead construction management, kind of operations management, vendor management, et cetera. So that's kind of generally how we split our roles. And then obviously, when we're looking at new deals, right, we're reviewing the underwriting together and all big decisions we make together.
Okay. And so you guys started in 2016?
Yeah.
So
our search started in 2016, but our first deal closed in 2017. Yeah.
Okay. So we'll call it 7.5 years. We'll split the difference. Yep. 7.5 years now. And you guys are, I know I looked at it before, but you guys have what, 1,900 doors?
Yeah. We've sold a couple of deals, but we, have acquired just under 2,000. So 1,950 or so across 9 deals, pretty much split between Dallas and Houston. And we've done everything from 1960s flat roof chiller to our most recent deal is 2015 construction, all pretty much suburban garden style. So we don't have any, mid-rise or high-rise or whatnot, but acquisitions, value add. And that's been our focus for 7 to 8 years. And we've tried to, instead of being the jack of all trades, try to be the master of one. And so yeah, that's really what we focus on. We've also got a in-house construction company. So we do all of our renovations in-house. We're actually doing that for third parties in Texas as well. And so we like, heavy value add deals, we know how to execute on those. But yeah, that's all of our deals have been between 125 to 300 units. So we try to stick to our criteria pretty well.
Absolutely.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done, have freedom in your time, and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. So now let's talk about how Catalyst Equity Partners had a deal in Houston, and there was some unforeseen hurdles that may have arose or have popped up during this deal. Talk to me a little bit about, how many units was it? Obviously, we know it's in Houston. And what drew you guys to pursue this deal?
Yeah. So, as many folks know, finding a deal is really tough, right? And so, I think a lot of people are thinking today in today's market, it's tough. Honestly, it was tough in 2016, 2017 as well. The competition is probably a lot more now, but when you're starting off new, you don't have a lot to lean on, right? And so, we kissed a lot of frogs for a long time. And like I said, ended up getting this deal under contract. So why we like this deal, it was in a suburb of Houston. So it's 125 units built in 1978. It had really good physical characteristics. So when you think 70s, you think boiler and potentially chiller. This one had all individual HVAC systems. It actually had individual water heaters per unit, pitched roof. So it kind of hit all of our physical characteristic boxes. It was in a growing market, in a suburb of Houston, just about 45 minutes south of the city. And, we were buying it at a, pretty good basis and a high cap rate, and so the nuance with this deal was that it had a, tax credit component to it, which, it was burning off, and meaning that like in the next 4 years, the restrictions were going to be lifted. So we saw a lot of value of buying that low basis now, and then being able to exit, on a 5-year plan without restrictions, right? So like we saw a lot of values where I think a lot of people just kind of shut the door on it. So we ended up getting this contract in, I want to say Q1 or Q2 of 2017. We went through, our diligence and whatnot. And, the numbers on this deal, this was like a 9 cap deal, by the time it closed, right? And this is in 2017. So they did exist way back then. And so what ended up happening is while we were under contract on this deal, we had, done our investor presentation, did all of our due diligence, raised our equity and all that. And Hurricane Harvey, for those in Texas, hit Houston, right? And so that, really kind of, fortunately, this property was totally fine, right? But, the lenders really got kind of nervous at that time, right? So we were trying to go for an agency loan. We were under contract for about 3 months. The seller had a few things that they had to take care of and whatnot. And so we were under contract for 3 months. We had an agency loan, kind of under application. But once Hurricane Harvey hit, the agency basically said, hey, we're not going to close this deal in another 60 to 90 days. We want to redo diligence, et cetera. And at that time, our sellers started getting frustrated because his numbers were going up, and we had to use one extension for Harvey and whatnot. And so at that point, we had to pivot, because he had given us an extension. And then the next extension was technically out of contract, right? So we had to get an amendment and whatnot. And so, at that point in time, we had 30 days to close, with this final new extension that we got. We ended up going bank loan. It was a local Texas bank that, liked the deal. They understood the market, they understood our business plan, and they were really, there's only a few options that could close in that short of a time frame, right? As most people know, agencies, Freddie and Fannie take at least 60 days, and CMBS and whatnot, similar, right? And so from like loan application to closing, I think it was like 21 or 22 days, you know? And so it ended up being a good thing. I mean, there was the other thing is we had to sign some partial recourse, right? So on agency loans, as most folks know, they're non-recourse loans, right? We had to sign some partial recourse because it was a bank loan. But we felt comfortable given the basis that we were going in at, we buying like at a 9 cap, or interest rate was 5 cap, and so, it was our first deal, and we had skin in the game in terms of our own money. And we also had, our balance sheets on the line with the recourse, right? And that, I think, resonated with investors as well. So we ultimately got that deal closed, and started, the post-acquisition part of the business, which, I tend to always say is the most important part, right? A lot of people talk about, the deal acquisition, the raising the money, and they think the finish line is we close the deal. Whereas I think everything pre, closing is warm up, and the starting line is kind of when you close the deal. And so yeah. So anyway, we got it closed. And then we started the fun part.
And let's talk about that fun part. So you got through a hurricane, you got through switching lenders. What was your guys' business plan or value add plan going into this? And how long were you giving yourselves to complete that value add or business plan?
Yeah, so these the value add plan here was, these were 100% classic units. There was about $150 rent premium from renovated to from classic to renovated, right? And so our plan was to do 60 to 70% of the units over the course of 12 to 15 months. And then obviously raise the NOI and either seek to refinance or exit, right? We were really pitching a 5-year hold. And so that was our business plan. But then, we hired a local property management company that, knew Houston, this area, but they didn't have a huge scale. And then two things kind of happened. One was we took over the property, the stated rent roll showed, 91%, right? But when we took over the property was actually only like 81% occupied, right? So that was a big problem to begin with. And then as we started renovating units, we realized that a lot of the existing tenant base, at the end, the seller was not, filling the property with the right tenants, right? And so that, combined with the fact that our property management company just didn't have the scale to manage, our property well. So we had to do two things. One, we had to fire the property management company within like 3 months, right? And so that was a huge learning experience for us because, I'm here physically in Houston, going to the property regularly and, buying our first multifamily deal, and we're kind of on our way. And then 3 months in, having to explain to folks that we had to fire our property management company. And the second thing that happened was when our second property management company came in, we were advised that we really have to clean house, and so then we ended up, having to drop our occupancy down to 60%, right? And so we dropped our occupancy down by design 60%. We're like 4 or 5 minutes into the project, we're, not, keeping up with pace with our value add plan just yet. And so, obviously there's a lot of stress going through that, right? But it ended up being the right decision because once we got down to 60%, we had the ability to renovate units, right? Because we weren't at 95% and having to wait for turn. We had units that we could renovate, 20 a month, right? And so that's what we ended up doing. We basically caught up by renovating a lot more per month. And then we pushed the marketing, right? And so that, essentially helped us get from 60 to like, I remember it was being 85 or 90 within 3 to 4 months, right? It was really aggressive. And, now we're at month 8, month 9. And yeah, so we ended up catching up. And, ultimately at month 15 or I want to say month 15 to 18, we had gone through, close to 50% of our renovations. And then we were at like 90, mid 90s occupied. And we, had to make a decision, right? So one of the other was to either, should we refinance, right? Or look to sell. and a lot of people can say, hey, you're only 15 months in, why looking to do something that soon? And it was a couple of reasons. One, another lesson learned that I learned from the beginning was capitalizing your deals heavily up front, right? And so we had a renovation budget, but a lot of these contingencies, right? We hadn't had that much experience previously. Looking back, we would have doubled our contingency bucket, right? Because stuff happens on these older deals, right? And so we ultimately were doing some analysis, and we said, okay, look, if we keep this deal for another 2 years, call it, we may not have the CapEx funds, right? And then the other, reason is that we wanted to show a win, right? We took this deal down to 60%, raised the NOI by like 25%. And, we were our first deal. We had bought a couple other deals along the way, right? And so we wanted to show our first deal. So we ended up deciding to try to sell it in, less than 2 years. And yeah, so ultimately got a good number in I want to say early 2019. And we ended up getting a 1.5 equity multiple in 2 years, 25% annualized. Our projections on that deal were 18 or 19%. And it was a good win because we, got a good result for our investors. But more importantly for us, not more importantly, but for us as sponsors, we learned so much on that deal, right? And quite frankly, the financial aspect as a GP on that deal wasn't, nothing to write home about. It was our first deal. We actually did very little sponsor compensation. We took no fees, just because we wanted to, prove it, right? But what we learned by going through the changing of lenders, by going through the firing of the management company, by going down to 60%, by realizing that we have to capitalize, we've taken all those lessons that, and applied that, on every single deal going forward from there. So
You mentioned a couple of interesting, I guess, concepts or principles that you used on this asset. One being not wasting time with a property management company and making that decision promptly and saying, hey, it's just not the right fit. We got to find someone else, instead of dragging that out 9 to 12 months. And then all of a sudden it's causing a lot more issues than solving them, which I want to commend you for that, especially on your first deal. The second thing that you talked about was, with the new property management company, they advised you to, clean house, like you said. And by doing that, you basically just expedited your guys' business plan. It's not like you changed it a whole lot. You just did it quicker than, you thought initially. And I'm seeing that more today because, everyone's heard about vacancy issues over the last few years. Not talking about finding deals, but just when you have a deal, there's a lot of vacancy issues across the country. And now from my conversations and what we're dealing with personally is a lot of delinquency issues, rent help, or I guess people getting rental assistance is running out and there's no funds. And so we're seeing a lot more delinquency. And what we've done is the exact same thing you did. We said, hey, we'll get these people out, or we have money left in the budget. We got to use it to renovate them and increase those rents on those units and get better tenants in there. And so, from personal experience, sometimes you have to make that decision. Obviously it worked out in your guys' situation, but expediting your business plan isn't always a bad thing. It is stressful coming from an asset manager myself. It is stressful, and there's definitely some gray hair popping up on my head because of it. But it's not. And I tell our investors that we're not changing our business plan. We are expediting it. The P&L and the income statement may not look great right now,
right?
But once we trust this process and get to the finish line on what we're trying to do, it will pay off. And you did that on your first deal, which I can't imagine making that decision and the stress that came with making that decision and ultimately getting that business plan done.
Yeah, no, it was, it was definitely stressful. But I think what you said was right on. You got to trust the process, right? Because we could have just, try to keep the occupancy where it was. And, then you deal with, long-term issues with delinquency, bad debt. You're not getting your rents. You're having a lot of skips, and yeah, you may have a higher occupancy on paper, but that does you no good for the long term, right? So we leaned on our experienced partner and the management company and said, okay, if this is what you guys think is the right way to go, we're in, just give us the plan. Right. And the plan was, hey, we're going to get down to this percentage of occupancy, and then we're going to renovate 10, 12 units a month, and we're going to lease up, 8 of those units a month. And based on our plan, we should be here by X month, and so yeah, it was, especially like you said on your first deal. That's why I think it's very important to be able to buy something that A, you could handle, and B, have the team there to support you through it.
Absolutely. Shane, did I forget to ask you, or did you not mention anything about this deal or Catalyst Equity Partners in general?
No, I think, I think on this deal, I mean, I think we covered it at a high level. I think, Catalyst Equity Partners, I mean, we've just, pretty much grown from this deal almost kind of in lockstep, right? This was like a $5 million deal, and the next deal we bought was larger, and we, raised more money. And yeah, I mean, I think, you're always just increasing the tools in your tool belt on every deal. If your listeners are looking to be a GP, I mean, there's going to be an element of, getting outside your comfort zone, but I think it's balancing that with the fact that you have the conviction that you can execute, and so yeah, happy to chat further about lessons learned or whatnot.
Well, yeah, if people want to hear more from you or connect with you, where can they do that?
We are pretty active on social media. So you could find us at on LinkedIn. So Catalyst Equity Partners. Our website is Cat Equity, CAT equity.com. And you can send me an email at Shane, SHANE at catequity.com. Happy to chat with any of your listeners and anyone interested in the multifamily space.
Awesome. Shane, I appreciate you joining us today, and thanks again for sharing about your Houston deal.
Thanks, Trent. Enjoyed it.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again, and enjoy your day.